While the inventory may still be limited and not even close to returning to pre-pandemic levels, there are finally more homes coming on the market. Hi, it's Brooks and Christopher Marr with MMG Real Estate Advisors, here to bring you the Orange County May housing market update. We're going to dive into the latest trends, data, and statistics to help keep you informed on what's going on. Also, you may have noticed this market report may look a little different as we are sitting in our newest listing, so be sure to check out our home tour video coming soon. Now let's start at active listings. Homeowners are starting to become more willing to sell after many held out because of high mortgage rates while they were locked into record low fixed rate mortgages. There are currently 2,470 homes on the market, its highest level since last year's November peak of 2,496 homes. Compared to May of 2023, inventory is up 13% this year. Although we're still below the pre-pandemic average, the market should improve once rates drop below 6.5%. Inventory is increasing in the higher price brackets with a 30% jump since the beginning of the year. This rise is mainly due to the accumulation of homes over $1 million, which have a longer expected market time compared to homes below $1 million. Now demand. Demand is indicated by the number of new pending sales over the past month, which increased from 1,707 to 1,759 in the last couple of weeks, marking a 3% rise and reaching its highest level since September of 2022. Although demand has not yet peaked for 2024, it typically reaches its peak between April and May. Now, if mortgage rates do drop later this year, as many experts predict, demand is expected to improve, potentially causing a later peak in demand. The Federal Reserve has signaled potential rate cuts this year, contingent on trends showing a cooling economy and falling inflation. Last year, demand was at 1,660, which is 6% lower than the current level, representing 99 fewer pending sales. With supply rising faster than demand, the expected market time in Orange County increased from 41 to 42 days over the past couple of weeks. Last year, it was 39 days, which is similar to the current level. But before COVID, the 3-year average was 68 days, indicating a slower market compared to today. In the past couple of weeks, the luxury inventory of homes priced about $2 million increased from 851 to 935 homes, a 10% rise, marking the highest level since October of 2020. Luxury demand also rose by 25 pending sales, up 10%, reaching 275, the highest level since May of 2021. With supply and demand increasing at a similar pace, the expected market time for luxury homes priced above $2 million slightly decreased from 103 to 102 days. This 102-day level is considered hot for luxury homes, driven by financial markets reaching all-time highs this year. Now, year over year, this active luxury inventory is up 228 homes, or 32%, and luxury demand has increased by 82 pending sales, or 42%. Last year's expected market time was 110 days, similar to today's. Now I'm going to pass it to Christopher for some key economic insights.
It was just 6 short months ago on December 14th when mortgage rates dropped to their lowest level in 7 months after the Federal Reserve felt that the inflation data seemed to convey it would trend lower in the first half of 2024. The Fed statement seemed to signal 3 potential rate cuts in 2024, which excited the markets. So far this year, the monthly economic data has sent mixed signals, causing the Fed to take a wait-and-see approach, despite indicating they're not opposed to increasing rates if needed. This is why we have seen mortgage rates yo-yo up and down this year, impacting buyer affordability and demand. Recent economic data seems to suggest that the economy is cooling, but inflation has been sticky and government spending continues to be a concern. Sure, the Fed's inflation target is 2%, but many feel the Fed should raise their target level to 3% because it doesn't make sense during this era of economic changes, like the disruption to the global supply chain, lower labor market growth, and constrained supplies on energy, food, and housing. Many housing experts have revised their predictions for 30-year fixed-rate mortgages, much like the Fed has done with their projection on the Fed funds rate in their quarterly dot plot chart. The Fed funds rate impacts various lending rates. While previous mortgage rate predictions for the end of 2024 were closer to 6%, many have revised their numbers closer to 6.5%. These mortgage rate predictions don't take into account buyers opting to pay discount points to reduce their mortgage rate. Now, it's important that we see mortgage rates stabilize and move away from the big swings that we've seen this year. Changing expectations have been attributed to persistent housing inflation, which makes up around a third of the Consumer Price Index, an indicator used by the Fed to measure inflation. Keep in mind, rent and homeowner equivalent rent that measure housing costs were two of the three largest inflation contributors in April. This likely means mortgage rates will stay higher for longer relative to historically low mortgage rates many homeowners locked in during the pandemic. We have to accept those 2, 3, and 4% 30-year fixed-rate mortgages are not realistic expectations in the foreseeable future, while many buyers have waited for those rates to come back or the market to collapse. Home prices have continued to increase. Well, there it is, your detailed update on Orange County's real estate market trends for May 2024. Monitoring these statistics and changes is essential for making well-informed decisions in this dynamic market environment. The latest data reveals a market experiencing shifts, offering both opportunities and challenges for buyers and sellers. If you found this video useful, please remember to like, share, and subscribe for more updates. Until our next update, take care, good luck with your real estate ventures.